Ever felt that exhilarating urge to just slay your debt, to finally be free of those monthly loan payments? You're not alone. Many small business owners dream of the day they can proudly say, "That loan? Paid. In full." But before you go all financial superhero and make that final, glorious payment, a little voice might whisper in the back of your mind, "Wait, are there any hidden fees for doing this?" That's the million-dollar question we're tackling today. Are there prepayment penalties for paying off loans early on Fundera? Now, Fundera has positioned itself as a go-to platform for small business owners seeking funding. They're like a matchmaker, connecting you with various lenders and loan products. This can be a huge time saver, sparing you the hassle of individually researching and applying to dozens of different institutions. You fill out one application and Fundera presents you with a curated list of potential loan offers. Pretty neat, right? But here's the thing about working with a marketplace like Fundera. They themselves don't actually lend the money. They facilitate the connection. This means the specifics of your loan, the interest rate, the repayment terms, and yes, those all-important prepayment penalties, are determined by the lender you ultimately choose to work with, not Fundera directly. Think of it like booking a hotel through a travel website. The website helps you find and compare hotels, but the hotel itself sets the rules for cancellations, extra charges, and so on. Fundera operates in a similar fashion. They provide the platform, but the individual lenders set the terms of their loan agreements. So the short, slightly unsatisfying answer to our main question is, it depends on the specific lender and the specific loan product you obtain through Fundera. Now, I know what you're thinking. Great, that doesn't really tell me much. And you're absolutely right. So, let's dig deeper and explore why prepayment penalties exist, what types of loans are more likely to have them, and most importantly, how you can figure out if your Fundera-sourced loan has one. Why do prepayment penalties exist? To understand prepayment penalties, you need to put yourself in the lender's shoes. When a lender approves your loan, they're essentially projecting their earnings over the entire loan term. They calculate the interest they'll receive, which is their profit. If you pay off the loan early, the lender misses out on some of that anticipated interest income. Prepayment penalties are essentially a way for lenders to recoup some of those lost earnings. They act as a deterrent to early repayment, ensuring the lender receives a certain amount of interest regardless of how quickly you pay off the principal. Think of it like a subscription service. You sign up for a year and the company expects to receive your monthly payments for that entire year. If you cancel early, they might charge you a fee to compensate for the lost revenue. Loan prepayment penalties serve a similar purpose for lenders. What types of loans are more likely to have prepayment penalties? While it's not a universal practice, certain types of loans are more prone to having prepayment penalties than others. Here are a few common examples. Commercial mortgages. These loans, used to finance commercial real estate, often come with prepayment penalties. The loan amounts are typically large and the repayment terms are long, so lenders have a significant interest in ensuring they receive the anticipated interest payments. SBA loans, in some cases, while the Small Business Administration, SBA, has regulations in place to protect borrowers, some SBA loan programs, particularly the 504 loan program, may include prepayment penalties, especially during the initial years of the loan. However, the flagship 7A loan program generally prohibits prepayment penalties for loans with terms shorter than 15 years. Term loans from certain online lenders. Some online lenders offering term loans to small businesses might include prepayment penalties in their agreements. This can vary significantly between lenders, so it's crucial to read the fine print. What types of loans are less likely to have prepayment penalties? On the flip side, some loan types are less likely to come with prepayment penalties. Lines of credit. These offer more flexible borrowing and repayment terms, and prepayment penalties are generally uncommon. Short-term loans. With shorter repayment periods, the impact of early repayment on the lender's interest income is less significant, making prepayment penalties less likely. Merchant cash advances, MCAs. While MCAs aren't technically loans, they provide upfront capital in exchange for a percentage of future sales. Their structure usually doesn't involve prepayment penalties in the traditional sense. The importance of considering prepayment penalties. Understanding prepayment penalties is crucial for several reasons. Financial planning. If you anticipate having the ability to pay off your loan early, knowing about potential penalties will help you factor those costs into your financial planning. Avoiding unexpected costs. The last thing you want is to be hit with a significant fee when you're trying to become debt-free. Comparing loan offers. When evaluating different loan offers through Fundera, take prepayment penalties into account as part of the overall cost of borrowing. A loan with a slightly higher interest rate but no prepayment penalty might be more attractive if you plan to pay it off quickly. Your mission, should you choose to accept it, is to become a diligent detective of your own loan documents. Read the fine print, ask questions, and understand the potential costs associated with early repayment. By doing your due diligence, you can avoid any unwelcome surprises and make informed decisions about your small business financing. With that said, thanks for watching, and until next time.